first order of business is covering arguably the biggest news bite for any investor, business owner, or even just a consumer out there, which is the fact that as of the latest FOMC meeting, Jerome Powell and the Federal Reserve gang finally pulled that trigger on cutting interest rates.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Of course, now the big fear amongst us investors is a recession hitting after a major policy shift. But it's important to keep in mind that Powell doubled down on the stance that if the Federal Reserve is not on a preset path, they're going to be able to shift gears should the data show economic signs of weakness. But it's also important to say this: if a recession is to hit, which it was supposed to hit 10 times over and years ago, then it's going to hit no matter what, and the idea is to just keep investing. Now, in due time, if we say recession enough times, eventually it will in fact hit. So again, it comes back to just investing into quality companies for the long term. And now, in terms of interest rates coming down, as we're slashing these rates, it's going to grant more spending power to us all, business owners, consumers, and all the alike. So businesses are going to get back to spending, consumers back to consuming, and as policy continues to unwind, well, what we're going to see is a reminiscent year like 2020 to 2021 where markets were soaring, which we already saw happen after the first phase now of rate cuts last week. So be aware of what's going on and invest accordingly. Moreover, put in the extra time to take a closer look into each sector and how each sector or each stock that you're going to invest into will be impacted by interest rates coming down. Now, this leads me to 6 dividend stocks that I want on your radar this week, whereas the first 2 are rebound opportunities, another 2 are growth oriented, and the final 2 will just be reliable investments for the investor who isn't really fond of market volatility. With that, up first, let's talk about Nike, ticker symbol NKE, which is the world's all-famous foot and athletic wear behemoth that has become arguably one of the world's strongest brands. Now, Nike has been in the red zone for quite some time, just given the nature of our economic backdrop with higher interest rates and inflation severely impacting Nike's bottom line, which is ultimately translated into what we've been seeing in terms of Nike's stock share price. As we can see, it's down by almost 5% on the year, trading for just $86 per share, which is actually better than the $70 per share we saw not too long ago. Now click into the max view and we're going to see plenty of greenery over the span of time. Paint an economic picture for yourself when it comes to a Nike play. Have consumers been busy buying shoes in excess or at least without financial restrictions? No. But in the new environment, we're likely to see consumer trends shift. That's great for Nike's bottom line and will soon be reflected in that share price. But clicking into Nike's financials here, we could see why I love this company. Talking about a company year over year that's been delivering through on revenue to higher highs. Yes, even in 2024, delivering through on $51+ billion. And as for their balance sheet, very clean despite all the economic troubles we've been experiencing. As of recent Nike news, Nike is also having Elliott Hill join them as CEO, which is going to further bolster Nike's confidence for me. New era, new leadership, new stock highs. And thanks to Nike being a dividend stock, here we are with a safely rated dividend stock pick coming in at a 1.71% dividend yield, to which it's maintaining a 40-year dividend streak, all while growing by an average of 15% year over year. And while on the topic of consumer-dependent stock picks, I had a toss-up between Louis Vuitton to mention and also Canadian National Rail, ticker symbol CNI, which is what I went with given the importance to multiple industries as a rail, trucking, and marine transportation and logistics company. But moreover, Canadian National, given its focus on transporting anything from automotive, coal, and fertilizers to grain, metals, and minerals, as well as petroleum, chemicals, and consumer goods, is highly likely to get a nice bounce back once rate cuts actually really hit. And we can see now that the stock has been beaten down, hovering around $117 per share. That's down by almost 7% on the year, yet clicking out to the 5-year view, we could see over 30% worth of appreciation and over 9,000% over the span of its lifetime. But scroll down with me to discover an income statement that shows plenty of revenue year over year, painting the picture for us all that logistics companies, regardless of our economy, are companies to pour money into. By the looks of Canadian National's balance balance sheet, year over year, assets continue to top liabilities by a long shot. So I say this is really an opportunity before the economy really turns around, and until then, we're going to collect on a 2.1% dividend yield, which has been gifting shareholders with a steady 16% growth rate year over year, while on a 27-year uninterrupted dividend track record. But if you're more interested in dividend growth and just overall long-term share price appreciation, these next two are your money makers. With one of the largest holdings in my personal portfolio, we have Alphabet, ticker symbol GOOGL, to which, yes, I'm well aware of all the antitrust lawsuits that Google is currently facing, and no, I'm not nervous in the slightest. I think Alphabet is actually well poised to continue to be a top-notch pick, and remain especially excited for companies to get back to advertising, because Google becomes the dominant advertising powerhouse that all of these companies are flocking to. Now, I want to actually jump into some sales figures with you when it comes to Google, and we could discover that back in 2021, Google's sales growth skyrocketed by 41%, which was all fueled because of lower rates and the opportunity for businesses to spend more money without much worry. We already see in the last 12 months alone 13% worth of sales growth, already outpacing 2022 and 2023 numbers, which to me smells like opportunity as rates continue to work their way down. So why jump into this stock right now amongst these lawsuits? Simple, because it's off the peak of just about $190 per share, trading for $163 per share right now, and it's a no-brainer to understand the bigger Alphabet picture, clicking out to the 5-year chart here. However, scroll down with me just to see for yourself that Alphabet is a money printing machine, bringing in billions of dollars year over year, with over $282 billion brought in just last year, and it wasn't even the most friendly of environments. And along with a rock-solid income statement, their balance sheet is even looking better, with fractions worth of liabilities in comparison to their assets. Of course, Google is not going to be your dividend yield whale, but if you're in for overall growth, it will deliver, providing you then with a sliver of a dividend coming in at a yield of 0.49%. Now, investors, 3 down, 3 more to go, but before I actually cover them, some personal YouTube analytics that I want to share with you. I realize that over 73% of you who keep tuning in video after video, week after week, are not actually subscribed. So I'm taking a moment now to ask you to subscribe and join this community if you're getting value from these videos, and I'm just going to come right out and say it. Your support makes a massive difference, and after recently quitting my corporate America job to join this whole YouTube journey with all of you, your help is needed. And on that same note, if you could tap on that thumbs up for me, it just lets me know that this video is actually delivering through on the content that you're looking for. With that, we'll get back to it with a mega powerhouse with Microsoft, which I won't go too far into detail about, but I will say that I think Microsoft, just being a leader now when it comes to AI, is just well positioned for the future. And with rate cuts having already notched down and more cuts coming our way, this tech titan is going to be a great pick. But right now, Microsoft, like Google, is down on the year here off the peak of $470 per share, trading for $435 per share. Now, clicking into the 5-year window, it performs through uncertainty as well, just as any of these other Mag 7 players have. But scrolling down, of course, plenty of revenue year over year, with the strongest year yet here, raking in over $245 billion, all while keeping a very clean balance sheet in terms of assets to liabilities. And in terms of a dividend stock to invest into, you're going to capture a smaller dividend here at 0.76% worth of a yield, but in terms of dividend growth, it surely delivers, with over 16% worth of growth year over the last 20 years, while remaining on an uninterrupted dividend streak for the last 18 years. Up next, I want to talk about a stock that typically flies under our radars. We have IDEX Corporation, ticker symbol IEX, which operates through 3 segments: fluid and metering technologies, health and science technologies, as well as fire and safety diversified products. In other words, solid segment diversification for products that are used in our everyday lives that we often don't think about. A great example, the jaws of life that firefighters use when you're in a car accident. Yep, all credit to IDEX. Now, after a year like we just had, we have this company off its peak of $245 per share, trading for $208 per share. However, in knowing the necessity of their product line, up 27% over the last 5 years and over 7,000% since inception. But here we are with yet another revenue generating machine year over year, all while maintaining a very clean balance sheet. Nowhere as near as much as some of the other picks today, but healthy to say the least. However, as a dividend investor, we are talking about a growth pick with with a 1.32% dividend yield. That may seem small, but certainly mighty, coming in with an average growth rate of 12% year over year and doing so uninterrupted for the last 21 years. And finally, we have Waste Management, ticker symbol WM, which is a personal favorite of mine given our reliance on it, the government contracts that it maintains for sanitation purposes, as it operates on 3 segments, from trash pickup, recyclables, to dumpster rentals. And every now and again, we see that it ebbs and flows with the market. So down right now as we speak by almost 4% over the last 6 months, trading for $204 per share. But if you're looking for real safety, Waste Management has you covered here, up on the last 5 years by over 77%. Plenty of greenery since inception as well, just given the nature of their business. That's also reflected in the income statement, with revenue that tops each year preceding, with a clean balance sheet as well, worth of assets to liabilities, given their only real spend comes down to trucking costs and maintenance. But your treasures are, of course, my dividends, as Waste Management boasts a reliable, growing dividend coming in at 1.47% worth of a yield, growing at a staggering average of 33% year over year, all while maintaining a 24-year dividend streak. Now, investors, there you have them, all 6 dividend stock ideas of mine for the week ahead. I want to know your thoughts on each of them. If you have better stock ideas than mine, or what exactly you plan on buying this week, so comment down below. Subscribe now if you didn't earlier, and be sure to join me here, right here, for more insights now.